You're listening to This Week in E-Commerce, the Ecom Nation podcast. Dive into the top online retail headlines with your hosts, Paul Waddy and Chia. Let's load up the cart. This Week in E-Commerce, episode 9, with Chia and Paul Waddy. Paul, can't believe it. We're almost into double digits for our episodes.
Funny, I thought we were past double digits. There you go, number 9. Okay, 9 since we started counting anyway.
That's right, 9 since we started counting. How are you?
Good.
How was Orange, I should say?
Yeah, took a trip to Orange for Small Business Week in New South Wales and took the family. Orange was great. Central Tablelands, I think the region is. So about 4 hours from Sydney, 3.5. I think the wine was great, bit of a wine region. It was pretty cool. So we've been in 37-degree weather in Sydney, and then we went to 4 degrees in Orange. But yeah, a bit of a shout out to Orange. Nice part of the world, and some really good entrepreneurs over there as well. So it was good. How was your week?
My week was great. I was over at Airwallex. I spoke at the Airwallex conference, so their Black Friday event on Thursday, along with Jess from Frank Body, Rachel from 3x1, and Alex Babbage from Kalani Keeney's. So they were on the panel, and I did the opening keynote, and it was a great event. It was a great event. The Airwallex guys, this is, I believe, the first event of the kind. So really, really well done event, and obviously really great content as well, if I do say so myself. But the interesting thing was that for a Black Friday event, how anti-Black Friday it was. It actually worked quite well. That a lot of what I spoke about was the need to not have a Black Friday, about that we are, as retailers, we are just continually making things harder for ourselves. We're just constantly going on sale. Expecting that to be a little bit controversial, but it was backed up by the panel, who pretty much just like picked up what I put down in the opening keynote and just dived into it for like an hour about how they've built 3 pretty cool brands, across Frank Body, Kalani Keeney's, and then also 3x1, which have new rollers and another brand, all in denim space, about how they've managed to build a great brand without actually going on discount. And the whole point of it was just about the importance of smart discounting, but then also building great brands which don't need to go on discount. So which is a common theme of what we talk about here.
That's cool. Yeah, I love that. Black Friday, the least exciting period of the e-commerce or retail calendar. So it's good to hear people not frothing constantly about it.
Yeah. I think if you're planning to do 60% of your annual rev in one period, I think you got to really be taking some hard looks at your business model.
Yeah. I mean, we've broken that down before, and just the ability to check your profits in that month, which a lot of people don't do. But I think it's a topic for another day. But the cycle you get into, and with Black Friday looked at as the Messiah, bit of a false prophet. But yeah, interesting.
And so some news this week we're going to cover off. First topic off the rank, we are going to be discussing NewsCorp launching their marketplace. Marketplaces being another thing which hard to make money in marketplaces. So what do you make of NewsCorp diving into the endorsed marketplace space? And what they're saying here is that they're launching a marketplace which is going to be curated by their team, who are going to be reviewing the products, and only going to have their products which they recommend and endorse on the marketplace, in a way to make shopping easier for consumers to find great products. What do you make of that?
I'm sure that's what they're going to do, Mal. It's going to be curated. It's going to be so good. It's going to be, it'll be exactly what you're searching for, and won't be pay-per-click or anything like that. I think, do we need another marketplace? Probably not. Is it a great time to start one? Probably not. Tough space, particularly as it's not their bread and butter. I don't know. Do I be positive or skeptical? I'm going to go with skeptical.
So you're bearish on this?
I think
I'm very bearish on this, by the way. So.
Yeah. Look, I read news.com.au sometimes for news, but it's largely entertainment. That's fine. Like they're huge, right? But you would know as a consumer of their media that a lot of it is sponsored. So we touched on this last week with Amazon, right? And basically Amazon in the US under a bit of pressure for, look, sponsored, paying to appear high in the search rankings is part of life, right? In Google, in Amazon, anything like that. So I will be interested to see if your average brand can get there and get a decent presence, or whether it'll just be like all purely sponsored and it will really be curated on taste, or whether it would be curated on who's spending the most advertising dollars. Look, I'll check it out. I think it's a really hard time to launch an e-commerce site, an e-commerce marketplace, hyper competitive. You're taking on some massive retailers here. So interesting, good on them, have a go. It's called Checkout. I just think it'll be tough. I have no idea about it. Number one digital brand with 11.6 million. So they've got an audience. That's good. I wonder from a retail perspective, have you heard any retailers talk about it?
No, none whatsoever. And that's the thing. It's not their bread and butter. There's already so many other marketplaces out there, the barbecues galore and the catch of the days, the catch.com.au. And other ones like Baby Bunting recently launching theirs. They've got an inbuilt audience already. Like they've got an inbuilt audience who are already there to shop and buy from them, who they're just hoping to spend more with them in the marketplace so they can, continue to make, a little bit more clip from them. Whereas news.com, they're coming into this from nothing. They don't have, any bona fides as far as a retailer goes. People aren't used to transacting, with this particular brand. So it really needs to be established as a separate standalone brand, which then doesn't leverage any of the benefits of news. But so I don't know how they can have their cake and eat it too. And also I don't really know how trustworthy they are in terms of their products anyway. So with their teams of reviewers and things like that, I don't see how that's any different to, other ones which have more credibility, such as a Choice, for instance, which have years and years and actually decades and decades of trust which they've built up. So I think it's going to be a hard slog for news to be able to, make a go of this. But, let's see what happens. Let's see what happens.
If you hit the link, which is news.com.au checkout, it's advertorials. So it's not product listing, it's advertorials. So I think it's it's a revenue stream for them to write paid endorsed articles, which they do anyway, but this is just probably an outlet for them to do more of. But I would be a little bit worried if people listening to the podcast or you and I haven't heard about it from a retail perspective. The first thing I read is like Dyson Airs purifies incredible new feature. Look, it's not super exciting, but anyway, whatever. Good luck to them. Welcome to the mix and see how you go.
All right, the next article we're going to talk about is from Airwallex. So Airwallex put out a press release last week announcing that based on their data, they have seen, get this, in Australia, a 2.9 billion year-on-year decline in online spending. That is just a ridiculous amount. We already knew that it was getting pretty soft. And even like the ARA today announced that, that Christmas is probably going to be lower spending than previous years. But that is just a gigantic amount. And in this is saying $2.9 billion down. Digital and technology and education all fell. And the only sector which managed to grow was online travel, which grew 12.75%, which, I can attest to from how bloody crowded the airport is every time I go there. But it seems that, discretionary spending is well and truly down at the moment. As we knew this already, but to see these numbers, to contextualize it in terms of $2.9 billion, and Harvey Norman as well, also reporting recently, I think they reported like a 32% decline in their revenues last quarter.
I guess we can't be in any doubt that things are slow. So for those brands out there that are sort of still thinking macroeconomic factors aren't at play here, or they don't affect you, they probably do. But if you're still growing in this time, you're doing exceptionally well. And $2.9 billion a year is an enormous amount. And we know that we've previously said together on this podcast that retail has gone backwards quarter on quarter. I think clothing has been hit. And times are tough when clothing gets hit, particularly with women's fashion. So yeah, I think it's just, it's again, it's just interest rates are high, inflation high, curb spending, price comes down. The problem is, personally, I'm not seeing a lot of prices come down yet on your household staples. But anyway, we'll CPI, I guess inflation eventually will come down. I think we're probably still in for a little bit of, as this number suggests, a little bit of a tightening of the belt. It's a bit sad, really, because that seeing a lot of brands holding too much stock because sales are a bit soft. So that November is going to be monstrous with sales, discounting through the roof. I think that's great for consumers, I guess, but I think it does damage to the industry overall because it trains consumers to wait for these massive sales. And there's no doubt in my mind that over the next 6 months, we're going to see more retailers close. Overstocked, low cash sales only happening when you're on sale. That's a fast road to nowhere.
And that's a really good segue into the main topic we're going to talk about this week, which is some very high-profile DTC brands are in a bit of trouble in the US. So the three which we're going to cover off in some detail are Parade Underwear, which is a brand which you and I hadn't really heard of, but recently were acquired by an underwear portfolio company who as recently as 2 years ago had a $200 million valuation, but then have now since been acquired for cents on the dollar, as well as Smile Direct Club, which a lot of people would have heard about. They're a very well-known DTC brand. They were one of the earlier players, I guess. They feel like they've been around for a while, who were at one point valued at $9 billion, but have recently filed for bankruptcy. And Blue Apron, who deliver household products, from losing quite a lot from their market capitalization. I think they actually IPO'd, but they lost $110 million and now have a 35 million market cap. So, and all these brands, from everything which we're seeing, are due to those exact reasons you talked about before, who are either holding on to too much inventory. Or in the case of Parade, if we talk about that one first, Parade were the darling of, the underwear brand for the TikTok generation. If you go to the website, lots of bright colors, lots of diversity, inclusion, really made famous through social media, but really collapsing. Despite the fact that they were growing 50% year on year sales growth, but then at a $200 million valuation, it all came crashing down when they realized that they were at the end of last year, they only had $7 million left in the bank and were unable to continue funding their growth pretty much. And the number which stuck out to me is one which we talk about a lot, which is they were spending 60% of net revenue on advertising, which is just an insane amount.
Yeah. So $200 million valuation. Did you see their numbers when they got that valuation? Were they profitable at that point, or are they just
No, they've never been profitable.
So that's crazy.
And I think with a lot of these brands, like the appetite for unprofitable startups, I think Michael Dell, founder of Dell Computers, shared his first P&L like about a month or so ago, which the first P&L from Dell Computers, and it was like they made $10,000, something like that, or maybe it was like the annual statement, but it was like they'd made $10,000, and he was just like, check this out, and he was contrasting that with how a startup launches now. They're expected to lose like $10 million. But he's making $10,000, and it just goes to show, like, the appetite for unprofitable ventures of any sort, whether they be tech or DTC, just isn't there anymore.
Correct. Yeah, and I think it's the article we're reading is a post from Ben Cogan, COGAN. Thanks, Ben, on LinkedIn. But looking at some of the other companies there that he's basically predicted that a couple of others are on the chopping block, and those are Allbirds, Rent the Runway, Bark, Grove Collaborative, AKA Brands, and Purple Mattresses. So we've spoken about Allbirds before as a pretty cool concept, but lost 101 million, shrunk 10% year on year. Rent the Runway lost 212 million. Bark lost 61 million. I mean, it just blows my mind that, one, who's making the decision to invest in these companies? And I feel sorry for any shareholders that have gone in and really done their money. And AKA Brands again is like a tough one at the moment. But there's a crazy valuations. We spoke about it here with, who's the one we spoke about it here with, Mal, the previous BWX, just paying ridiculous amounts for businesses that they shouldn't. And then let's be honest, just not running them well. And I don't care what anybody says, the best private equity firm in the world or publicly listed or the A team in management spending 60% into marketing is just bad business. And it's all misaligned. They're obviously going for growth at all costs to deliver, great earnings reports. But earnings should be, it should always be about profits. And even in my limited experience in selling a business or raising capital, in my experience, aside from the really weird ones that get hot, and this parade underwear is purely looks like some social media phenomenon, but mostly the better deals from a private equity or even a trade point of view come in when your business is making a profit of greater than $3 million a year. That's just my experience. I just seen businesses go in with no profit, and they just don't get valuations, and these stupid results every now and then that get people really excited because some moron has paid over the odds for some crappy business losing money, and then everyone goes, I know, I can have a crappy business and lose money and then sell for 100 million. And it's a warning again for founders, I think, to not hold out for that sale. I hope you get it one day, and I hope one day when your hard work's done, you can rest. And but life's short. You've got to run your business profitably so you're improving life today, not improving life in 10 years. So no one ever looked at a profitable business and laughed, Mal.
Well, I think a lot of it is not knowing your unit economics. And the thing about when you have these tech valuations for D2C brands is that in tech, your marginal costs are fixed. You can keep scaling from 1 million customers to 10 million customers, and your marginal costs relatively stay the same. Whereas in D2C, they don't, because you need to scale production. You're going to need more team. You're going to need more warehousing. All your costs increase. The bigger you get, your costs increase. Yeah. So I feel in some of these companies, they just haven't figured out how to actually scale their costs. They don't have they fundamentally don't have good unit economics in some of these brands. If I look at Allbirds, Allbirds have had a growth at all cost mentality, and they just haven't been able to grow. They haven't been able to, it feels like a lot of the investments they're growing and pushing into other countries, into opening omni-channel, has been a big focus on going into that next stratosphere, of that brand, but haven't been able to take that leap. And I've looked at some of these other brands as well, similarly with the AKA making all these very big acquisitions of the Princess Pollys of the world, the Culture Kings of the world, expecting that to propel them to the next stratosphere or being able to take these brands to the next level, particularly in the US. And it just hasn't eventualized. It just hasn't eventuated over there. And I know that Princess Polly, we talked about a couple of weeks ago, have opened a store, I think in Rodeo Drive or something like that. It's a very high profile location. It's very expensive. It's a very big bet, but do the fundamentals stack up? Do they actually have good unit economics? Does this company actually have really solid bones to be able to grow from? So what I'd probably like to see is that a bit of change in that mentality from this growth at all costs of we have to be a $100 million brand to a $500 million to a $1 billion, to actually go where are we actually comfortable? Where can we actually take this business and have a really, really good, solid business? I feel it's a bit of a change in mindset now from people actually, not just eating what they need rather than trying to get everything, trying to get the whole smorgasbord, just trying to get the things that they actually need. Yeah.
Is Allbirds publicly listed? I think.
No, I don't think they are.
Yeah, it's just interesting. I think it might be actually, is it? Allbirds stock was soaring today. Anyway, I think the point is, it just comes back to, again, a lot of these publicly traded businesses, the share price is kind of what's driving decisions, and that the share price is often, unfortunately, manipulated by news and often manipulated by just pointless news. like we talked about last week with Lululemon and Peloton.
Yeah, great for Peloton.
Yeah, exactly. It's like
literally.
their share price spiked, like great, like just on sentiment, and unfortunately, like a lot of businesses just want to put out news, and that news tends to be, oh, we grew again. Whereas I guess there's a responsibility or lack of for small investors publicly trading on the ASX or the NASDAQ. Most of them don't look at profitability. They're just looking at what the market's doing. They're looking at what news are they putting out. But if you broke down the P&Ls of some of these businesses that we're talking about, they make or the unit economics, they make no sense. I remember seeing like one very big Australian food business, one of those food prep businesses, and their prospectus was being passed around, maybe not for the first time. And I just looked at it and had gross profit of 37%. And I was just like, this business will never, ever make money. But the person that sent it to me said, see, valued at 300 million or something. And I was like, check back in 5 years. Like, let's see where good luck to you if you buy in at 200 million on a business that's 37% gross profit.
I was at Uber at one point. We had a $90 billion valuation, and the share price is not what not what I bought mine at.
Yeah, exactly. So it's crazy, but I don't know, too complex for me. I just like good, simple businesses that help me make money to buy shoes.
That's right. Your TN addiction. My TN addiction.
Your TNs.
Just looking at Allbirds now, actually, their IPO price was $15, where they finished trade on the first day of trade at $28 USD, and that was only in November 2021. The share price is now $1.26.
Oh, it's abysmal.
And that is horrific. And that's, I think a lot of it's like, the whole dream of having an IPO. Like IPOs generally, for the most part, I think Jason Andrews might have said this actually. The IPOs, for the most part, don't make anyone except for the bankers rich, because the bankers are the ones who benefit the most. Like the company will go public, they'll put a percentage of their stock, onto they'll list a percentage of their stock. They'll list it at a sweetheart price for the bankers, for the bankers' clients, to get that day one pop. Then in general, like that day one pop is getting less and less and less. Like right now, it's probably only about 20%. And then if the business doesn't have good bones, it's pretty quickly exposed, like an Allbirds, whereas you've got other brand companies, which I know it's only been like a few weeks, and Klaviyo, like we've talked about before, they're still trading above their day one, which is fantastic. Their IPO price was $30. They're still trading at $33. So they're just above that at the moment, which is good. And that's showing that, they've got a business there. They've got something which people believe in, and they've got something stable there, which can continue to grow. And I do believe in that one. Whereas other brands like DTC brands, like unless the unit economics are really good and they've got a good path to growth, I just don't see how they're going to be able to justify some of these valuations, particularly when you're spending 60% on your advertising. And even then, like just going back to the Parade example, they were saying 60%, and their objective the following year was to reduce it to 40%. I was like, guys, it's like moving deck chairs on the Titanic.
Yeah, 40%, and then their revenues will shrink because they're dependent on paid media. But yeah, it's a slippery slope. It's and when you don't get it right from the start, it's really hard to correct, because you become dependent on the sales to cover your fixed costs, even though you're losing money. It becomes a mess. At what point do you put it in the bin and start again? But good lesson for the smaller businesses out there, just to focus on getting the unit economics right from the start. Because
grow profitably from the start. Don't try to just throw more money at it to grow and like reach stratospheric heights only to have like no money left in the day.
Scale doesn't fix poor unit economics. Like, yes, in theory, you scale your revenue and the dollar gets bigger, but it's such a stressful game, and you're so volatile. When your revenue drops, you've got to go on sale. So, high margin businesses for me are just not praised enough, not talked about enough. But love a high margin business, Mal, just sets you up for a much better journey as an entrepreneur, I think.
100%. All All right, Paul, what are we looking forward to this week?
You're back in Sydney with me again. We are hosting we being Ecom Nation, our agency is hosting a lunch session with Clavio, where we'll be talking to Lee, the CEO of Keisha. Unfortunately, that's sold out, that one, but we'll probably have a recap on socials, so follow us on socials. And then we are bit of a call out to Adelaide. We are in Adelaide later this month doing a Shopify meetup again with Ecom Nation. If you're in Adelaide, feel free to reach out and see if you're eligible to.
Yeah, actually, it's Shopify. It's the Adelaide Shopify meetup with again with Clavio. So Clavio this time have come on board as a partner with us to bring this event to Adelaide. It's a great community building event, really, just to get the whole Adelaide e-commerce and Shopify community together. So it'll be a lot of fun, and a couple of great guest speakers as well. John Craig from TWI, aka Shields Group, and then the one and only Paul Waddy gracing an Adelaide stage with his presence for the very first time.
Yeah, that'll be fun. Yeah, I think where is it at, Mal? Mismatch Brewery. So
Mismatch Brewing, yeah.
Generally, there'll be some good food, a few drinks, some really good ecom chat, and yeah, always good to get out to sunny Adelaide, Mal. One of my favourite places in the world. So I'm looking forward to that. Busy month ahead.
As it should be. As it should be.
Yeah.
All right. Well, that's all we've got time for. All right. Till next week.
See you guys.